All right, good evening, everyone. I hope you're well. I hope the new week is going on well for you. I know most of you might have resumed work now. So I hope your work is well as well. So basically today we want to interest ourselves in something very small, and then we should be able to go. So I have this paper. I shared it with, I think, people who are on the revision group. I think I didn't share it with some other people. So what I'll do, I'll just share this paper I'll share it so that other people can also get it. It's a trial paper, it's a mock exam that we did at one point in time. Okay, so I've shared it with you in the chat box. So for us to also know is that financial accounting, of course, as paper one, is a paper that is of 3 hours, 15 minutes. And 15 minutes, you expected to use it for reading and basically to select the questions that you're going to do. Okay, so reading and the questions that you're going to do. Now, of course, we have different sections, but this is something, this was set a bit different. Basically, the normal kind of paper that we're doing currently has 2 sections, has section A and section B. And section A usually has multi-choice questions, and there are usually 20 of them. And then section B has what you would call structured questions, and then you ask to select at least 4 of them. Okay, so that is what basically happened. So as achievers, we try to give mock exams to our students to help them get a feel of how a paper might look like. Okay, yeah, so today I want to interest ourselves in this section A, the section A paper, section A component, as we can learn of these concepts, and maybe also to help you even as you prepare for your exams. But not only for exams, but also for your understanding. Yeah. So question 1 says, which of the following calculates the trader's net profit for the period? Which one calculates the trader's net profit for the period? Now, we know very well that for us to calculate our profit, we draw up our statement of comprehensive statement of income, the income statement, or an statement of comprehensive income, or P&L. And once we've gotten the profit, the net profit, we transfer this into our balance sheet. Okay, so we transfer it in our balance sheet and we put it under equity. The profit is, of course, added to any cumulative profit from previous periods, which is called your retained earnings. So this question is asking us about profit from the perspective of our balance sheet, the statement of financial position. So as we've taken it there, they're asking us, how can we calculate our net profit? So option A is saying we do closing net assets plus drawings, less capital introduced, less opening assets. Okay, that is the first. Then option B is telling us we do closing net assets. We do closing net assets minus drawings minus capital introduced plus opening net assets. And then the other is telling us that we do closing net assets plus drawings plus capital employed capital introduced plus opening net assets. And then the last one is telling us that we do closing net assets minus drawings plus capital employed minus net assets. Okay, I think even before we get into to choose which of the option is right, I think it's imperative for us to understand what is net assets. What is net assets? Because unless you understand what net assets, then you may end up not being able to understand what this basically means. Okay. Now, I'll give you an example. If, for example, a company owns, let's say, 10 million in assets, and then it has, let's say, 6 million in liabilities, then the difference is what we are calling the net assets. The difference is what we are calling the net assets. It is basically your total equity in this case. It is basically your total equity. Okay? So, if we are looking at, of course, if we are looking at our equity, so here they're asking us, so if we have our total equity that we are beginning with, which they are calling either opening net assets, and then we have what we are ending with. Remember, what we are ending with already includes the new net profit for the period, in addition to what existed. You get it, huh? Yeah, in addition to what existed. So for me to demonstrate this much better, I think I'm going to use to show you from Excel. And I'm going to take my time because I want you to learn some concepts using what we are learning today. So our net assets, we are saying is the same thing as total assets less liabilities. So if we have our equity, if we have our opening equity, okay, me use the net assets so that you just know. So this is equity also. So everywhere you see me using equity, I'm meaning net assets, the same thing. So if I have my opening net assets, the question is going to be, what do I add on this to get my closing net assets? Okay, so on my opening net assets, if I want to get my closing net assets, remember, I'll get my opening net assets and I'm going to add capital introduced in case you started with a given level of equity and during the period there was some capital that was introduced, then you add that capital. You get it, eh? And then not only that, we also go ahead to, of course, add the net profit. Remember, the profit that we get from the P&L is supposed to be added here. Okay? Not only that, if we have drawings, we less drawings. Remember drawings, this is the amount of money that the owner has taken from the business. So I'm just trying to get even some of the terms that I already have. You get it, huh? Of course, we can have different other elements of equity, but I'm just trying to pick what we have here, okay? So that we don't take a lot of time. But other elements of equity could be thinking about general reserves. You could have things like, for example, you can have preference shares and so on. So if you have your net assets, your beginning equity, and then you add your capital introduced, and then you add your net profit and less drawings, it should be able to give you your closing net assets. Should be able to give you your closing net assets. So if somebody wants to make net profit the subject here, it is basically, I can arrange this in the way that you can understand. Opening net assets is equal to, okay, let me do this. So this closing net assets would equal to, we shall have our opening net assets, then we shall add capital introduced, and then we shall add our net profit for the period, and on this we shall also subtract. In most cases, what usually happens, they usually subtract drawings before even they add the net profit. So let me just demonstrate it here. So we shall first subtract our drawings, and then after the drawings, we shall add our net profit. That is what we basically do. So if we want to get the net profit, make net profit the subject, it means we shall take all this side. We shall take all this the other side. So our net profit would equal to, the closing net assets less, okay, closing net assets. Let me first less capital employed, or capital introduced, sorry. After that, I'm going to less my opening net assets, and I'll add my drawings. You know why I'm adding my drawings? Is because drawings here have a negative. So that is why I add them. So this is what the net profit should be. So if I go to my objectives, what I should be able to see is something similar to that. So anything that is now remember, drawings have gone the other side and are now positive. So anything that has drawings negative, that should be something I'm going to put my eyes off. So drawings should be added back to the closing net assets if we are determining the net profit. So this, again, this one is less in capital employed and less in opening net assets. Let me see how this is if this is the same thing. So it is closing net assets, less capital introduced, less opening net assets plus drawings. My answer is much likely to be option A. You get it? It picks out very, very well. It picks this very well. Remember, I've disqualified this one and I've disqualified this one. Now, the reason why I also disqualify this one is because it is adding it is adding drawings and also adding these other, yet these have to be subtracted. You get it? So my option is option A. So that should be your thought out process on this question. So that is what the examiner wanted to test. Wanted to test basically, do you know net assets first? And then you know how to make adjustments on net assets, which is your equity, to get the new value of equity. You get it? So we've been able to understand how that comes. So this was your answer. Answer A. Okay. So I'll go to my second question. And somebody says, which of the following is not part of the accounting regulatory framework in Uganda? The accounting regulatory framework of Uganda. Basically, of course, we have to know that whatever we do in accounting is regulated by certain bodies and also by certain documents. So yes, we have the Company Act. That one, of course, stipulates, for example, us preparing financial statements for public companies and publishing them and so on. We have accounting standards, which are usually international, guiding us on how to, of course, prepare financial statements, but also recognize any kind of transactions. And then we have the Financial Institutions Act. This is very common when it comes to financial institutions. It also stipulates certain ways how financial institutions should work. And one of it is around being requesting financial institutions to publish their financials in the newspapers. Now, when somebody includes the word source document, the source document is not an accounting regulatory framework. It is only part of the accounting process. Source documents, these are documents, for example, where we first record transactions as they happen. An example of a source document could be an invoice. It could be for example, a receipt, because it is from those documents that you pick details and transform them into transactions you post in your book of original entry, and then transfer them into your ledgers. Then from the ledgers, we transfer them, of course, to our trial balance as well. So here, the answer was B, which is none. This is not a regulatory framework. It's just a statement. Then the next one, somebody says, which of the following is not a contra entry in the cash book? Which one of the following is not a contra entry in the cash book? Now, anything is called a contra entry if basically it is movement of cash to bank, or movement of money from the bank to cash. It's basically money for the business is moving from one kind of storage, maybe storage facility, to the other. You get it? Either you have cash and then you go and bank it, that is a contra entry. If you have money in the bank and you withdraw it, that is a contra entry. And we usually record this within the cash book by indicating a C. You get it? So for example, if we are removing money from the bank, that means we shall credit our bank and debit cash. If we are removing money from our cash at hand to take it to the bank, definitely we shall go ahead to credit our cash because it's losing, and debit our bank because it's gaining. Now, if we read through here, somebody says trade receivables set off against trade payables. That is one. Somebody says withdrawal of check from bank for petty cash. This is a contra entry. Okay. It's a cash sale made and banked by the cashier. This also has a contra entry in it. Okay. And then the other says a check received and cashed on the same day. This is also a contra entry. Now, the first one, trade receivables set off against trade payables, is not a contra entry. Is not a contra entry. That is called offsetting. Okay, that is called offsetting. So that is why if maybe you just need a definition for contra entry. A contra entry basically relates to transactions that involve cash and bank. You get it? So a transaction that affects both your bank and cash account is called a contra entry. Okay. So the answer here was A. I hope you're marking yourselves, those that were able to try out this question. Okay. Yeah, in case you pass it, you just drop in the chat box and say, I passed that one, and we celebrate you. Okay, the other says, which of the following does not form part of financial statements? Which one of the following does not form part of financial statements? 1, the statement of financial position. 2, the operating and financial review statement. The other is the statement of cash flows. The other is notes comprising of a summary of significant accounting policies and other explanatory information. Definitely, this is a financial statement. This one is also a financial statement. This one is also a financial statement. Now, this one, if it was a statement of comprehensive income or income statement, we would regard it as a financial statement. But if it's operating and financial review statement, I don't know if you've heard of this, but myself, this is something that I've not heard about. Okay, and it's not bad. Now, remember the financial statements we have the statement of financial position, we have the statement of changes in equity, we have the statement of comprehensive income, we have the statement of cash flows, and lastly, we have the notes. You get it? So the notes to accounts are part of financial statements. Okay, the next question says, which of the following best explains the interest system of paid cash control? Which of the following best explains the interest system of paid cash control? Now, if, for example, what happens with paid cash is that, especially with the interest system, is that you have a given amount of money that your paid cash is at, the level of your paid cash is at. For example, your paid cash can, for example, at 500,000. So it means that every time your paid cash drops by 500,000, you replenish with the difference between what you have and the 500,000. Okay, so that is what basically happens. So in that case, if this is the question they're asking us, one is asking us, telling us, A is telling us weekly expenditure cannot exceed a set amount. Of course, this is not. When it comes to paid cash interest system, we are saying you have a given limit of amount, and if it gets done, you're able to replenish with amount top up. You get it? Then all expenditure out of paid cash must be properly authorized. This is just a control. Then regular equal amounts of cash are transferred into paid cash at intervals. No. The exact amount of expenditure is reimbursed at intervals to maintain a fixed float. The exact amount of expenditure is reimbursed at intervals to maintain a fixed float. This is the one. So our answer is D. Weekly expenditures cannot exceed that. With paid cash interest system, it doesn't set a limit that maybe your weekly expenditure should not go beyond maybe 500,000. And by the way, if you have a paid cash interest system and maybe your limit is 500,000, you can even spend ₦1 million during the week. But what you basically do is that your float does not go beyond 500,000. So it means that today you can spend 300,000, and because you have another expenditure of, let's say, maybe 700,000, or okay, maybe 500,000, so you'll go back and replenish. You get it? You go back and replenish to go back to the 500,000. So that is what the Impress system does. I would encourage you to read more about it if this confuses you. Yeah, there's a lot of information that you can really find about the Impress cash system. Then the next one is saying the document issued by the buyer accompanying goods returned to the supplier is documents issued by the buyer accompanying goods returned to the supplier is goods received note. The goods received note is a document issued by the buyer to recognize that they have received goods. They basically register that document to indicate they have received the goods. It's basically an internal document for the buyer, not accompanying goods back to the supplier. The credit note, now you need to understand what a credit note and a debit note is. A credit note is a document. A credit note is a document that is sent to correct an overcharge. Okay, it is sent to record any overcharge. In most cases, this credit note is sent from the supplier to the buyer. And the reason why this credit note comes from the supplier to the buyer is earlier on, the supplier must have invoiced. Earlier on, the supplier must have invoiced the buyer. So for us to reduce the amount that we invoiced earlier on to the buyer, we have to send them a credit note. Okay? And this credit note could be a result of goods that were actually returned by who? By the buyer to us. Remember, it is from the supplier to the buyer, not the buyer to the supplier. So in this case, the credit note would not work. It would only work if at all it was issued by the supplier. Okay? Good for us to note. The debit note. Debit note is a document sent by the supplier to the buyer to correct an undercharge. To correct an undercharge. Circumstances where we can have this document is where maybe we sent the buyer more goods than what we invoiced them. So we send an invoice to correct what we had undercharged them. Okay? Or if the buyer requests for more goods, then we send them a debit note. This is also from the seller, the supplier, to the buyer. Now we have the statement of faulty goods. And this would have been my choice for this question, because this is a document that comes from the buyer to the supplier. And like they have told us here, document issued by who? The buyer. If this was document issued by the supplier and it has things like goods returned, my answer would have been the credit note, because it corrects any overcharge. But since it is from the buyer, I'll confidently circle item D. Okay, I move. Which of the following items is likely to be paid out of petty cash? I think even before we proceed, I believe you're trying to look at these things and you're wondering how can you be able to answer these questions, because sometimes these things look like familiar to each other. You get it? And remember, these are 20 marks of section A. You want to get at least some of these marks. Yes, sometimes thinking through this may take time, but make sure that you don't lose these marks. At least out of 20, have an 18, then you'll be very good to go. Then you know that in section B, you'll be looking out for, let's say, maybe your 52 to make a 70 or a 62 to make an 80. Okay? Yeah, remember this paper is a paper that you should really get good, very good marks, and it's very possible. As long as you understand the concepts. Some of these things is good for you to go back and read notes. I know some students don't want to read notes because they feel, if I know calculations, these notes things, they are not relevant. At the end of the day, it will catch up with you when you're looking at objectives and all the objectives look the same. Yeah. So the question is asking, which of the following items is likely to be paid out of petty cash? Definitely small expenses are, petty expenses are paid out of petty cash. So we have the first one, payment for a motor vehicle. Of course, that one, no, you wouldn't pay a motor vehicle from petty cash because petty cash limits are like 1 million, 2 million. Yeah, I once worked in a company where our petty cash was 20 million, but this was a very established business. But even 20 million in such couldn't buy a new vehicle. So payment of motor vehicle, nah. Payment of a computer for office, no. Hire purchase payment for a trader, apana. Payment to a cleaner, yes. That one is most likely to be paid through petty cash, because the cleaner will just want a few shillings and they are good to go. Okay. Yeah. And then we move to the next one. Which of the following will appear as a debit balance in the ledger accounts? Which of the following items will appear as a debit balance in the ledger accounts? Okay. Now, we have subscription in arrears. Remember, items that appear with a debit balance in the ledger accounts are either assets or expenses. Either assets or expenses. It is assets and expenses that have a debit balance. Anything else away from there doesn't have a debit balance. So let's see. A subscription in arrears, assets or expenses? Subscription in arrears. Subscription in arrears are very common with non-for-profit organizations. And if it's subscription in arrears, it means that certain members didn't pay their arrears, didn't pay subscription, so we are yet to receive money from them. Okay. Capital is equity, and equity has a normal credit balance. Subscription in advance. Subscriptions in advance, this relates to where some members pay subscriptions before the elapse of the period. For example, if I pay my subscription for CPA for the next 2 years, that will be subscription in advance. Yes, bank overdraft, this is a liability and it has a normal credit balance. Subscription in advance is also a liability. Okay, is a liability because unless the period elapses, you cannot recognize those subscriptions in your books. Okay, so it's important. Now, somebody will challenge me here. If they are a bright student, they will challenge me and say, what if it's the company that is paying subscriptions? What if it's a company that is paying subscriptions? Now, of course, for matters of this paper, when you see the word subscription in arrears, subscription in advance, definitely yours should run to non-for-profit, okay? Because it is only where we study about the subscriptions and so on, okay? But in case, of course, yeah, in case it is us that we are paying subscriptions as the organization, I don't know how we can pay subscriptions, but maybe we subscribe to maybe Uganda Manufacturers Association, and then we pay subscriptions in advance. In that case, a subscription that is paid in advance will be an asset to us, and a subscription that is in arrears, that will be a liability to us. But for matters of this question was looking at a non-for-profit. Okay, not spoken about anywhere, but that is it for you. Okay, so just to understand what has a debit balance and what has, remember, ledger accounts are T accounts. Okay, and these balances are basically what is the balance brought down. Then we have the other. They're saying which of the following is a record of prime entry? Which of the following is a record of prime entry? Remember our books of prime entry from the accounting process? We say that we move from the source documents. Then from the source documents, we go to our books of original entry, which include sales journal, purchases journal, general journal, return inwards journal, return outwards journal, and so on. And then from there, we move to ledgers, balance off to our trial balance. We have end of year adjustments, and then we prepare our financial statements. Even from the trial balance, we can correct some errors, if any, and so on. So if they're asking us which one is a record of prime entry, remember we have purchase invoice. This is a source document. A purchase invoice is a source document. Trial balance, this is not a prime entry. Remember, trial balances come in after the ledgers. After we've done the ledgers, that is when we balance off and get the trial balance. Sales invoice, same story. This is a source document. A journal is a record of prime entry. And that is why we have the sales journal, we have the purchases journal, we have the return inwards journal, and so on. You can call it a sales day book or a sales journal. Okay, so that should be able to. So a journal is a book of original or prime entry. So I would circle C. Okay. Did I say what I circle here? I said I circle area, substitution in area. Yes, substitution in areas. Okay. For number 10, which of the following errors would be found by extracting a trial balance? Which of the following errors would be found by extracting a trial balance? 1, the double entries were made the other way around. Now, here basically we are looking at, if they're asking for errors that would be found by extracting a trial balance, it means which are those errors that affect the trial balance, okay? That if that error is made, your trial balance will have different totals. The debit and credit will have different totals. So we are looking at the entries were made in the wrong way around. This is a complete reversal, where you're supposed to debit cash and credit. Okay, debit cash and credit purchases. Okay, no. Let me, for example, maybe you sold goods to for cash. So you have cash and then you have sales. Okay, so debit cash, credit your sales. So if you just do a complete reversal of saying you debit sales and credit cash, that transaction will not be detected by the trial balance. So that one gets off. Non-current assets posted to expense account. This is an error of principle. Okay, errors of principle will not be detected. Reason why, if you're posting a purchase of a non-current asset to the expense account, remember assets and expenses have a debit balance. So this will not be detected by our trial balance. Then we have a transaction was completely omitted in the accounts. A transaction was completely omitted in the accounts. Errors of omission are not detected because you've omitted the debit side, you've also omitted the credit side. So this is not detected by the trial balance. Okay, we move. Different figures were entered for the debit and credit entries. Different figures were entered for the debit and credit entries. Now, this one affects our trial balance because remember you've entered a wrong figure. Okay, different figure on the debit, you've entered a different figure also on the credit. So this one would ideally affect your trial balance. We move to the next one. So your answer would be D, definitely. We move to the next one. Which of the following entries correctly record the credit purchase of furniture and equipment? Remember, which of the following entries record the credit purchase of furniture and equipment? Remember, we have furniture and equipment as assets. When assets increase, we debit them. And since we are buying on credit, we have a supplier's account. So we look at this: debit supplier's personal account, credit furniture and equipment. Totally wrong. We cannot credit furniture and equipment unless we were selling them. Debit furniture and equipment account, then credit supplier's personal account. Okay. Let me first leave there. Let me first look at other options. You know, when you're doing objectives, you don't make a choice before you look at other options. You may think that is the answer, but when there is actually a better option. Remember, these are multi-choice questions. So we look at C, debit furniture and equipment account. That is good. Credit bank account. Why do we credit bank account when they have told us it's a credit purchase? So there is no money that is moving out. We've not yet paid the supplier. So this is wrong. Debit bank account. Credit furniture and equipment. This is wrong. This will happen in the books of the person who is selling to us, in the case we are selling to us on cash. Okay, but remember, it is us who are purchasing. Remember, it is not a credit sale, but a credit purchase. So myself and any bright student would come and circle that one. Okay, would come and circle that one. Somebody says recap V3. Okay. Which of the following items appear as a debit balance in the ledger accounts? I said the items that appear with the debit balance in the ledger accounts are either assets or expenses. So if I look at this, subscription in arrears. Subscription in arrears, if it's a non-for-profit, which we are considering here, like I indicated earlier on, the subscription in arrears are usually money that members subscribe to our non-for-profit need to pay. So if it's subscription in arrears, means we've ended the period without them paying. So it is an asset to the non-for-profit. Capital is equity. Equity, it has a normal credit balance. This is not part. Bank overdraft, the same. These ones also have a normal credit balance because they are liabilities. Subscription is in advance. This is basically where members give us more of their money before the elapse of the period. Okay. Now, this subscription in advance, until the period elapses, there will be liabilities within our books or accounts. So the answer for V3 is subscriptions in arrears, which is A. So I hope that is understood. Whoever had asked through the chat box, Sheila and Martha. Okay, so we are done with X1, and we chose this one. Okay, we move to the next one. The double entry for bad debts written off is to, yesterday I just had a class with students that are subscribed for the normal class. By the way, this is a revision class. We also have a normal class for those that subscribe for the full-time class, where we do revision and also go in these topics in depth. So yesterday we are looking at bad debts written off. Okay, so they are saying the double entry for bad debts written off is to 1, debit bad debts account and credit sales account. B, debit trade receivables and credit bad debts account. C, debit bad debts account and credit trade receivables account. D, debit your sales account and credit bad debts account. Anyone who was part of the class to tell us which of the options? I think I have Michael. I have other people. If you were part of the class yesterday, please tell me the answer before I tell you the answer. Anyone to try? Or even if you're not part of the class, but maybe you've been reading, you can use the chat box to just try that out. Okay, somebody says B. All right. Now, bad debts. Of course, bad debts. This is a component of our trade receivables that we think will not be able to pay us. So these bad debts can either be doubtful debts, or they can actually be confirmed bad debts that we write off. Now, when we write off bad debts, it means we've confirmed that these people will not pay us. For example, either maybe somebody disappeared, or they moved to another country, or they died, or a company went bankrupt, and so on. So we go ahead to write off our bad debts. Now, the key thing that we do when we are writing off our bad debts is to write off directly the trade receivables. Remember, we are writing off the bad debts, so it's no longer provision. We are no longer providing for bad debts, but we have to go ahead to write off that component of our trade receivables, which are our debtors. Okay. So when somebody says we debit bad debts, yes, in every time we're writing off, definitely we debit our bad debts, and this component goes to the P&L. So yes, option A is right of saying we debit bad debts, but then they are saying we credit the sales account. Okay, they are saying we credit the sales account. Is that right? I doubt it is right, because already at this point in time, we already recognize this as a sale. It's sitting within our trade receivables, so we don't again go to the sales account. The next one is saying we debit our trade receivables account and credit bad debts account. We don't do this because we only debit trade receivables when trade receivables are increasing. But remember, in this case, we are writing them off, so they are not increasing. We cannot debit trade receivables, so that one I will nullify it. And we can also not credit bad debts account. Okay. Then the next one is debit bad debts account, debit bad debts account, and the credit trade receivables account. Now, this one is actually our answer. We debit our bad debts account and credit our trade receivable. Let me look at the last option B before I make my circling. Okay. Debit sales account and credit bad debts account. I don't want to bring sales at this point in time because I already recognize them and this money is sitting within trade receivables. So I wouldn't bring them in this level. Okay. So good for us to note that. So we have we have our answer as C. Okay, thanks to all those that got C. Ramadan, Mbabazi, that was nice. So the next question, says, which of the following would not appear in the company's statement of changes in equity? The statement of changes in equity looks at the different equity components, which is share capital, preference shares, general reserves, okay, and so on. Now, somebody says interest on loans, on loan notes. Now, interest on loan notes, this is an expense. And expenses don't appear within our statement of changes in equity. So I first leave A alone, which has doubt. Dividends paid, these appear because dividends reduce our retained earnings, which retained earnings appears within our books, within our statement of changes in equity. Total comprehensive income for there, this appears there. Remember, this total comprehensive income for there adds on to the retained earnings to help us get the new value for retained earnings. Surplus on revaluation and of non-current assets, this definitely appears there as well. We also have a revaluation account in the statement of changes in equity. So I'll definitely circle part A, okay, which appears within our statement of comprehensive income. It doesn't go to statement of changes in equity. Okay, then I move to the next one, which is saying which of the following is false in relation to IS2 inventories? Which one of the following is false in relation to IS2 inventories? Now, inventory, IS2 is the standard that measures inventory, okay? And it says that we should recognize inventory at the lower of cost and the net realizable value. So A is saying selling costs are excluded from the cost of inventory. Is that right? That selling costs are excluded from the cost of inventory. Remember, when we were calculating our net realizable value, we bring in aspect of selling costs. So the next one is saying inventory may be measured at cost or net realizable value depending on the preference of management. This one is totally wrong. It is false. This one is false. IS2 inventory says that management should value its inventory at the lower of cost and the net realizable value. So it's no longer, it's not a preference of management. It is the standard. So I already have a wrong answer. Let me just confirm that these others are all right. An entity shall use the same cost formula for all inventories of similar nature and using the entity. This one is also not right. You should you can use different formulas. The financial statement shall disclose the amount of inventories recognized as expenses during the year. This is right. Okay. This is right. This is right. This is right. And it shall use the same cost of formula for all inventories of a similar nature. Yes, if they are similar nature, if it is soda, it is soda. So you value it in the same way. Okay, but if they are different, then you should use a different formula. So this is also right to note. This is also right. Selling costs are excluded from the cost of inventory. When you're calculating the net realizable value, definitely you exclude the selling costs. Okay, because you're looking at the net that you remain with, the net realizable value. So our answer here was B, which is totally wrong. Okay. So the next one says dash is a check paid out but has not passed through the banking system. Dash is a check paid out but has not passed through the banking system. Dishonored check. A dishonored check is a check that you submit to the bank and the bank refuses to give you money. In simple terms, maybe it has the wrong signature, maybe it has the wrong date, maybe there's no money on the account. So it's not at least A. Uncredited check Uncredited check, this is cases where you give a check to, okay, you receive a check from your customer, and then at the end of the day, at the end of the period, this check has not been credited on your account. Remember, when it comes to bank, if it's a check that is coming to you, the bank is supposed to credit you. So if it's a check that has not been credited to your bank, then that is an uncredited check. Then we have a standing order. Standing order is where you instruct the bank to be deducting an amount of money from your account, maybe to pay rent, could be to pay subscriptions, could be to pay premiums like insurance premiums and so on. I have a standing order with one of the banks to pay my life insurance every month. So, and then we have D, which is unpresented check. D, which is unpresented check. Now, the unpresented check is where we issue this check to our suppliers, but at the end of the financial period, they have, okay, the end of the financial period, yes, they have not yet presented it to the bank. Check paid out but has not yet passed through the banking system is definitely the unpresented check. If they had said check received, it would be the uncredited check. So our answer is D, unpresented check. This is more around, you master this so much with bank reconciliation. Those that have been to one of my classes where I taught bank reconciliation, you must be getting that very well. Okay. Which of the following should be charged against profit rather than as an appropriation of profit in partnership? Which one of the following should be charged against profit rather than appropriation of profit in partnership? So we have 1, interest allowed on partner capital account balances, interest charged on partner drawings, interest payable to partners on any loan, salary payable to the partner. Which of the following should be charged against profit rather than as an appropriation of profits? Now, when you're dealing with partnership accounts, you have 2 things. You can there is what you do within against profit before you get to appropriation. When you get to appropriation, basically you want to share the profits between the partners. So we have adjustments that we make before we can share profits to partners. Now here they're asking us which of the following should be done before we actually get to appropriation of profits, before we share profits. Now, whatever is done within the appropriation account usually affects all the partners, okay? Now, before we get the profit to share, what should we charge? Interest allowed on partners' capital balances. This is an appropriation profit, an appropriation item. Interest charged on drawings. This is also something that we should look at of course, we should be able to look at the other level of appropriation. Interest payable to a partner on any loan received by the partnership. Now, this is interest that should be charged on the profit. Interest payable to a partner on any loan received. This should be deducted from the profits, that i.e. charge the profits before we can go ahead to appropriate the profits in the partnership. So I would choose C. Salary to be payable to the partner. This is deducted when we are doing the appropriation there. So I would choose C in that answer, in that question. I move down to the next one. A receipts and payments account is one which is not for profit-making entity. A receipts and payments account is one in which a non-for-profit making entity derives its surplus or deficit. No, a non-for-profit derives its surplus or deficit from what we call an income and expenditure account. Shows its opening and closing cash balances. This is right. Shows its revenues and expenditure. Apana, this is for the income and expenditure account. Presents its financial position. This is in the statement of financial position. So the answer for me would be B, because it's the receipts and payments is like a cash book for a non-for-profit, where we record our cash and opening and closing balances. So I'll do this on the other. So my next question, which of the following statements is false? An asset should be classified as a current asset. Of course, if it's for a period less than 12 months. Is held primarily for trading purposes and is expected to be realized within 12 months. Okay. The next one is expected to be realized in the normal course of the organization's operating cycle. Is a cash or cash equivalent. It resulted from past transactions or past events. Now, they want a statement which is false. Now, resulted from past transactions or other past events, this is right. This is part of the recognition of assets. Assets should only be recognized if they are as a result of past events. Cash or cash equivalents, yes, these ones are also assets. Things like bank, cash, okay, treasury bills, is expected to be realized in the normal course of organizations' operating cycle. I would actually, this is also right. It's held primarily for trade realized within 12 months. So I would go ahead to circle this, not basically operating cycle, okay? Not basically operating cycle. So I would circle B to be the false because A, C, and D are right. So I move to my second last. Which of the following best explains revenue recognition as an accounting conversion? Revenue recognition as an accounting conversion. Those that are part of my full-time class, you must remember this was part of what we looked at, and you can find it in your notes, okay, about revenue recognition. So A is saying revenue is recognized when an invoice is raised by the supplier. When you just raise an invoice, do you recognize revenue? What if the goods have not been received by the other person? Revenue is recognized when goods are supplied to and accepted by the customers without reservation. Okay, sounds good. Revenue is recognized when goods are supplied to and accepted by the customer. Okay. Revenue is recognized when customer makes orders for the supply. So I'm going to remove because they want us to get what best explains. So if I leave out anything, doesn't mean that maybe it is wrong, but they want something that best explains. Now I'm going to exclude A. Revenue is recognized when an invoice is raised by a supplier. You don't just, it's not that when you raise an invoice, you recognize revenue immediately, because you might have raised an invoice when you've not delivered the goods and have not accepted the goods. Okay. I'm going to exclude also this one. Revenue is recognized when a customer makes an order for supply. If a customer has just made an order, they have not yet taken the goods. What if you make the order, you meet the order and they are not interested in what you've made? So that alone would make me remove A and B. So what I'm remaining with is revenue is recognized when goods are supplied to and accepted the customer without reservations. And then revenue is recognized when goods are supplied to and accepted by the customer. Now, when somebody says without reservations, this would best recognize the revenue. Okay? Remember here, the customers just accepted the goods, but what if they come back and said, you actually gave us the goods that we didn't accept? So this is the best point when revenue should be recognized. Okay? When we've supplied goods, the customers accepted them without reservation. So there is no credit note that will be coming through, there is no return that will be coming, and so on. So I'll definitely circle B to me. You might be circling another answer from you, but according to my understanding, that is what I would do. Okay. Then lastly is about provisions. Lastly is about provisions. And it's saying a provision should be recognized when a provision is to be recognized when. Now we have different types of provisions. We have provision for bad debts. We have a provision for depreciation. We can have a provision for unrealized profits. Yeah, we can have different provisions. So provision recognition. Provision recognition. Now, they are telling us that to recognize provisions when a reliable estimate can be made of the amount of obligation. A, it is probable that an inflow of resources is likely to accrue to the organization. An entity has no present obligation as a result of past event. The settlement of obligation is not enforceable by law. Now, we recognize provisions. Those that want to learn more about provisions, so IS 37. Provisions are like liabilities for layman's understanding. But in this case, these liabilities don't meet certain ethics of normal liabilities. Are we together? So that is why we make just a provision. Like, for example, when you're making a provision for bad debts, you're saying that these guys may not pay. So you're making a provision. Now, the standard says that we should recognize a provision. It gives us conditions. One, a present obligation has risen as a result of a past event. Okay? So there should be a present obligation as a result of past event. So anything that says an entity has no present obligation, I'll exclude it. Now, the next criteria that provisions should be recognized, provisions should be recognized when the payment is probable. You're likely to pay the payment, okay? Now, when somebody says it is probable that an inflow of resources is likely to accrue to the organization, it's not an inflow, it is an outflow. So this is also wrong. When someone says an inflows only come in when it's their assets. So that wouldn't come. Then provisions should also be recognized when the amount can be measured reliably. Okay? Now, we have excluded this, we've also excluded it. Let's look at this. The settlement of obligation is not enforceable by law. If it's not enforceable by law, then why do you make a provision for it? Okay? Because this would mean that it is not probable that this amount this payment would be made, because it's not enforceable by law. Okay, you can also make provision, by the way, for cases if you have a case in maybe in court, and you expect that maybe you might lose the case, you can make a provision at the end of the financial period. So based on that, I would actually take A, because A meets the condition of recognition for provision. So that is what I would choose. So in case you feel you need more of these things and you've not subscribed to our normal classes, please subscribe the classes so you can be able to get all this information in detail. Okay, practice as much as you can. Yeah, I'll try to get some students, some of you, some of other objectives. I'll try to look around to help you practice. Okay. Okay. Okay, thank you. I saw without reservations. With reservations. Okay. I didn't see the word reservations. Thank you so much. For this, since this has reservations, our answer would be C. Thank you, Sheila and Martha. Yeah, for highlighting that, had missed that out. Okay. So it would be C. C would be the right answer. Brilliant, students. So make sure that when you're in an exam, you read through and understand this very clearly. Okay. So that is how we end our objectives. Objectives, by the way, you master these objectives by practicing, of course, objectives, but reading the notes and understanding them, understanding the accounting. You don't cram, but making sure that you understand everything as it is. Okay. So thank you so much. Get more multiple choice questions. Yeah, these are not because ISPAL does not leave these with the students, so they're not very common. But we'll try to look for some of these for you as you prepare for the exams. So thank you so much for being part of this. I wish to end here. In case you want to be part of more of our classes and you've not yet subscribed, reach out to me on WhatsApp. My number, you have it, or you can just WhatsApp 070-380-3255, 070-380-3255, and we'll be able to help you see how you I'm going to say the score at 16 out of 20 classes are really helping. Okay, I'm humble that the classes are helpful to you. Yeah, I look forward to sharing more with you as we get on this journey of learning. So thank you so much, and I wish you all the very best. Okay, bye-bye.